We're live, Jimmy.
Yay, good morning, good morning. Technology.
Yeah, we've had our challenges today.
You know, I saw Arnold Schwarzenegger being interviewed yesterday on The View, and he wrote a book called Be Useful, and they were interviewing him about his book. And Diana, my girlfriend, said, well, he's written like 50 books or something like that. I said, oh, come on, he's a movie star. So I said, hey, Google, how many books has Arnold Schwarzenegger written? 70.
Oh, my no.
I
Wow.
know. And so then I said, how many books has Trump written? 90. Like 71 and 92 or something like that. Where do these guys find to write a book? How do you find you're the governor of California, you're a movie star, you're a real estate investor. You know, Schwarzenegger was a millionaire before he made his first movie. You know that, right?
Really? I'm
Yeah.
gonna. So hold on. I'm gonna.
Okay.
Hold on just a sec.
Yeah.
Okay, can hear me. Okay, we're good. Sorry, I wanted to make sure that my voice, even though you can't see my face.
Yeah.
So what was the last thing you said?
Well, Schwarzenegger came to America with no money. He came to be a bodybuilder, compete in the bodybuilding circuit, and he started buying real estate in California. And before he made the Conan movie, which was his first big hit, before he made Conan, he was already a millionaire from his real estate investments.
I didn't know that. Diane found that out?
No, I knew that from before. Because
Oh.
no, we talked about when he came out with this book called Be Useful, and they interviewed him. She said, well, you know, he's written like 50 books. I said, get out of town. So I said, hey, Google, how many books has Schwarzenegger written? 71 or 73 or some crazy number. How do you find time to write books?
That's amazing. Yeah, really. Well, I guess between movies, or I don't know.
You got to have help. I mean, there's no way Trump could find time to write 90 books. So he's got to have ghostwriters that help him with that. He just talks to them and they write it down. That's how Mike Ferry wrote one of his books that I'm aware of. He had a ghostwriter and she just followed him around and she just wrote everything down he said. And the next thing you know, they had a book.
Yeah, that was a few years ago.
Yeah.
I think he's only written one.
Oh, no, he's written a few.
Has he? He's done
Yeah.
so many videos. Jimmy, what's going on in the market?
Well, you know, you gave me this sheet yesterday that's on the screen, and I'm looking at this sheet, and the first thing that jumps out at me is 23.62% of year-to-date daily sales are non-owner occupied. That means investors are buying 1 out of 4 houses, non-owner occupied. Investors have not fled the market.
That's true. They haven't. Do you think
And then,
it's they have cash?
yeah. And so the next thing I look at then is the $1 million homes, and 1,073 year to date, average 4 per day, every day 4 a day, $1 million homes. The money, if you follow the money, I mean, that's as good as we've almost ever done. It's really close to our record, 4.58 in 2021. And you know, you shared with me last night there was this. You said that we went up to 88 per day or something like that, which is we're ahead of this time last year.
Well, yeah, we're doing 88 daily sales, but in October we're doing 56 a day, and last October we were doing 52 a day. So we're doing 4 more per day, and it says 3, I guess, because there's fractions in there. But anyway, yeah, it seems like you said the interest rates hit us last October.
Right. And a lot of deals fell through. So we're not having deals fall through anymore because of interest rates. We're having deals fall through. Sometimes buyers get cold feet, but it's not the interest rate because we already know that.
But if you look at 2022 overall, we were doing 112 sales a day, and we're doing half that now.
Yes.
We're doing 56 sales a day right now in this current October month.
Yeah.
And in all of the average for 2022 was 112.
Well, 2022 October month to date was 52. So October's always slowed down. They talk about some markets where there's snow and hurricanes and they're seasonal, and they say Las Vegas isn't seasonal. I would beg to differ. If this happens every year in October, that's a pretty significant drop.
It is, yeah. Well, we're still selling homes, but not as many. The interest rates are bothering some people, and I believe yesterday in our Chris Voss class, which was awesome, by the way.
Thanks.
It's a shame more people didn't come because we did invite outside of our company. So I'm going to put another, by the way, I'm going to put another video out there for people to come, correct?
Yeah, sure. It's
They
Friday.
just have to come to the classroom. It's not a Zoom class.
Right.
Right. But so anyway, that was an awesome class yesterday. And somebody in the class said that there are Canada and another country, I forget which one, someplace in Europe, where you can take your mortgage with you. So if you have a 3 or 4% mortgage and you want to go buy another home, you can take that mortgage with you. You just have to pay the difference in the equity or the down payment as it is.
I think that was Annetta because it's called Porta Mortgage, and she was telling me about it too. So I think that might have been her, but it's something different for us for sure.
It really is. I think that would solve all our problems, but I don't know. I mean, and the other thing too, Jimmy, I thought about this. So if I have a 3% mortgage and the mortgage company says, okay, you can move that mortgage, but I'm going to raise you 2%. Now there's a mortgage company that wouldn't have gotten a mortgage. Okay. But at least they're going to keep the one you've got and add 2% onto it. I think we need to start thinking outside the box here, maybe.
Well, on the chart that you have on the screen, the thing that impacts me the most is the percent change in home prices since Q1, first quarter 1991, Q2 2023. Now, I realize that's 30 years, but percent price range, 297%, national
Yes.
average, 300%.
Yeah.
So I realize it's 3 decades, but real estate is and always has been the best way to accumulate wealth. We're not good savers as a country typically. So if I bought something 30 years ago, it's tripled in value, and by now it's paid off. And I think what agents have to come back to is, what is the basic reason people buy a house? And I should say basic reasons, because there's more than one. And the first one is shelter, obviously. And when you rent a house, whether you rent it or buy it, you're getting shelter, but you have no control over rental. If the landlord decides to sell it, you got to move. And that's a problem. So the reasons for buying a house haven't gone away. And when there's less sales, that means maybe a little bit less competition for buyers. When do you buy a house? When nobody else wants to. That's the ideal time.
Exactly. Yes. And so what you're saying is, well, if this is kind of, if we're lagging behind in sales, maybe it's the time for people to buy. Because if the interest, I mean, there's different scenarios. If the interest rate goes down, then people are going to come back into the market. There's going to be more competition. The prices might go up. Although some people, which we're going to hear in this video in a minute, some people are predicting that the prices are going to go down like 30%. And if you bought in 2022, I mean, prices have escalated 42%. So if you bought, which is insane. So if you bought in 2020, let's say, you're still okay if prices do go down.
I just don't see prices going down. I mean, they've been saying that for some time, and it hasn't happened. And rates have gone continuously up, and fewer buyers in the market. So less mortgages to make. Lenders have to make loans or they go broke. I don't see average price, median price is still, you showed me a 10-year chart, and we're like the last 4 years, we've been really flat, 450, 450, 450.
Yes. And in other places, prices are fluctuating, some up, some down. California, they're down. Austin, they went down. Dallas, I think some went up. Some places in like Connecticut, prices went up. So it's scattered throughout the market. And like you said, real estate is local. Yes.
Yeah, I'm just looking at this chart that you have on your sheet here. I mean, people should, when somebody says, what do you think is going to happen to prices? Well, I got to ask them, are you a short-term thinker or a long-term thinker? Because if you're short-term thinking, that's a trap of real estate. You don't get into real estate short-term. You get into real estate and you hang in there. Some of the commercial investments you told me that you and John made, you guys held on to those for 25, 30 years.
Yes, some of yes, we did. And we made money.
Yeah.
But yeah. So that was a good thing. Jimmy, you want to watch this video? It's about 20 minutes long, but it's really interesting.
Okay, I can watch most of it. I have to go to the meeting at about 10:05, so I got 25 minutes I can watch.
Let's see, that's the wrong
Oh,
one.
looks like it might play.
Hold, please.
Okay.
Where did it go? There it is. Okay, so if there was logic to this thing, it would be much better.
Well, I know you're good at programming in computer language because they are logical, but this is not it. So,
Okay, so here we go.
good.
I'm going to mute us so that there's no echo.
Cool.
Data analytics, ICE Mortgage Technology is the actual name of the company. And the vice president of data analytics for years with real estate data firm Black Knight was where these comments are coming from. Black Knight just purchased ICE Mortgage Technology. Okay, so there's the background there on that. Andy Walden is the vice president that we're referring to. And the big headline here from Andy is the U.S. housing market has gotten so expensive that income would have to jump 55% to make buying affordable, quote unquote, affordable, according to this real estate executive. So these are the headlines. It's in Yahoo Finance, it's in Fortune, it's splashed across many different outlets that consumers are going to be reading. Now, there's no question we can't hide from the fact that October is the most unaffordable market month in the housing market's history, beating only September last month and then August before that. So we're in a consecutive 3-month run of housing affordability issues. It's a very unaffordable market. Those are the facts, but where are the opportunities? Because the more they see this, if you look at home affordability, quote unquote, from Andy Walden, if you look at home affordability itself and what it would take to normalize the market today, it's a 35% correction in price or a 4% decline in mortgage rates. That's not happening. Or a 55% growth in income, or some combination of those. And our friend over at Fortune, who did the interview, Lance Lambert, he put it together pretty concisely on Twitter X. We'd return to what he calls pre-pandemic housing affordability if one of those three things happened: the 55% U.S. income spike. We've never seen a 55% spike in incomes in the U.S. in history. So I think we can cross that out. Over time, will we get there? How many years would it take? The answer is many. It would take many years to get there on a 55% U.S. income spike. U.S. home prices falling 35%. Let's take that one, for example. U.S. home prices falling 35%. Even going back to the crisis that we all know of, the great financial crisis, even going back to that, we would be hard pressed to get 35% fall on home price values. Okay. If we just take a look at one of my favorite charts of all time, home price growth by months into the decade, Lance Lambert from Fortune put this one together. If we just look at this, in the decade of the 2000s, we did see a plus 80% spike in home prices leading up to the great financial crisis. And then we saw a near 30+% drop. So that is your example of a 35% drop. There's no other decade you can point to as a 35% drop actually happening in the 90s, the 2010s. Certainly, we haven't seen that yet in the 2020s. Side note, all 4 decades for homeowners, you have a 30% or more total value increase in homes that are across the U.S. So for anyone thinking that home prices go down and never go back up, the last 4 decades straight, you've got 90s, 30+%. You've got the 2020s, we're at 40 right now, or just under 40 in some markets. The 2010s, you're at 45. And then even in the 2000s, with that decline that I'm referring to after the great financial crisis, you still had in that decade over 40% home price growth. Okay, so when you look at it on a 10-year run, owning a home is where you get this type of acceleration in asset growth and asset value. All right. But a 35%, going back to that, can that happen? Would that happen? Well, this is nothing like the great financial crisis. We have 10 times less capital availability in mortgage. We're not writing loans. The mortgage industry is not writing loans like they were during the great financial crisis, meaning not everybody gets one, not everybody qualifies. One of the reasons we have a 27, 28-year low in the mortgage demand, according to Mortgage Banker Association, which we mentioned on yesterday's stream on the hot sheet here. One of the reasons for that is because of how strict after 2008 in 9, 10, and 11, they made it to get a mortgage. It's very hard to get a mortgage. We also have less capital in the market that we've historically had. And remember the letter we talked about yesterday from NAHB and NAR and MBA to Jerome Powell, to Fed President Powell, Fed Chairman rather Powell, even reference in that letter. If you start selling more mortgage-backed securities, then we're going to have even less capital available. So it's not just the rates that's suffering on demand, it's how hard it is to qualify. It's a much different, because remember, back in the great financial crisis time, it was 7.5%. It was 8%. The difference was anybody could get a loan. If you could breathe and you could sign your name, you could get a loan. It was ninja loans, right? No income, no job. You didn't have to have verification and you could still get a loan. Not happening today. Where do foreclosures sit? Well, they sit near all-time lows today. Very unlike that situation. It would take a long time for us to start to see the level of foreclosures, the level of delinquencies, the level of pre-delinquencies that we saw during those years. So we're nowhere near, a GFC, a great financial crisis type of situation. And I would argue that even when we saw interest rates go from 2.5, 3, all the way up to 7.5 last year, the biggest impact we saw was in places like Austin that maybe got a little overheated. Places like Boise that certainly got overheated with how many people were buying in Boise from places like California. And even there, we didn't see anything close to 20% drops. We actually saw 10% drops at the most. So home prices falling 35%. You'd have to see the worst economic collapse that we've ever experienced in this country, in my belief, for us to erase the 40% gain that we've experienced for home prices to fall 35%. Oh, by the way, if they did fall 35%, you'd still be up 5% if you bought in the beginning of 2020. How crazy is that? If home prices cratered 35%, you'd still be up 5% since 2020. There's a very low likelihood of that happening. 42% of homeowners across the country don't have a mortgage. So you can take 4 out of 10 homeowners out of the picture that aren't going to sell their home for a 35% discount. Why would they? They have the protection of having no mortgage. They're not feeling the pain of 8%. Then you can take 83% of mortgaged homeowners. You can take them out of the picture because they have an interest rate of less than 5%. And where jobs are in this country right now, why would they sell at a discount? Why would somebody sell 3%? That's a hedge against inflation for them. Why would they sell at 3% unless they were relocating or some other scenario? And that's one of the reasons we've seen inventory get held back along with our lack of production. So then we're left with, if incomes are not going to spike 55%, if home prices aren't going to fall 35%, we're left with mortgage rates need to fall 4 percentage points. Okay, not going to happen. Not going to happen. Now, eventually, can we get down to low 4s or mid 4s? Yes, we can, and I think that we will. But when I say not going to happen, don't start spreading the news. What's that New York? Spreading the news. No, don't be spreading the news that rates are going to fall 4 percentage points in 2024, because we know that the path that we're on right now is pointing towards interest rate being higher for longer. And actually, Lance writes here, the point being, we're not on a path as of today towards pre-pandemic housing affordability level. So this is the situation that we need to get comfortable with here going forward. Housing affordability takes into account incomes, national prices, and mortgage rates. So when you hear that lowest level of affordability, those are the three metrics that are being taken into consideration. There's a great piece on Housing Wire I want to point to here for a second. And this doubles down on what I just said. 8% mortgage rates are a new reality. Okay. So we've been talking about the impact, but we need to be comfortable with this being what we're going to be operating in for not only the short term, but start putting that into your business plan for 12, 24 months out. Maybe not 8%, but higher, certainly for much longer. If you plan on 24 months and it ends up being 12 months of a higher interest rate, if it comes down next year in the fourth quarter, good. You've planned so far ahead. You've been so conservative with your outlook in investing or operating your real estate business that you can ride the wave down and be super comfortable with that. Okay, so this is 8% is now common. So home buyers are just, some of them are just going to be priced out. And here's the argument the Housing Wire says homes are going to sit longer. You're starting to see that a little bit. Higher rates typically, now this is where we can have a little bit of a debate here, Housing Wire. Housing rates equal more inventory. Okay, well, we've seen inventory tick up a little bit. We always report on inventory with Altos Research on Mondays, and we've seen a little tick up in inventory, but we're still year over year negative from last year on active inventory at this moment, and we're still at an all-time low for new listings. So there's a little pushback there that these higher rates haven't actually equaled more inventory. It's been one of the trends that has bucked historic measures when you see rates go up. Lower rates typically will equal less inventory. Well, the rates were super low when we had low inventory, and now they went up and we still have low inventory. So the path to finally having more selection for home buyers is through higher mortgage rates. Now, I agree with that to some degree. The path in a situation where we're at right now, when we look over the next 12 months, quarter 4 of 23 to quarter 4 of 24, the path for home buyers to have more selection on homes is that with higher rates or lower rates. Okay. Now, higher rates, you will hopefully see this trend that's been historic where more homes are going to sit and they're going to have more selection, like we've seen the last 30 days or so. We know over the next 12 months, we're not getting any supply to help us. We don't have an abundance of supply like we have in multifamily to help out. So if we got lower rates, would that actually help out? You might see some sells, but those are all buyers. So they're eating up the inventory just as fast with lower rates. And what happens in that scenario? You see prices heat up again, which can be even more impactful on affordability than what we're dealing with now, which sounds crazy to say. If mortgage rates were to fall between now and January, this is from Housing Wire, expect to see inventory decline again next year like it did for most of this year. If rates stay at 8% or higher, their expectation is you will see inventory rise in 2024. We'll be dealing with more inventory in 2024 for those who can purchase. Okay. So this is a silver lining moment to educate buyers and investors on, hey, the rates for those that can afford are your friend right now when it comes down to options and choices on the market. The more that we accumulate inventory through this winter, the more choice you'll have December, January, and February, which are often the best 3 months for buyers and investors to capitalize. So this 8% higher for longer could be a benefit for those seeking choice. Okay. Fewer sellers are seeing the upside of listing now. New listings volume each week remain very low, and there are very few sellers who want or need to sell in this market, and there's no flood of sellers. So the hope here is that you're going to see days on market increase, which is going to increase the inventory. The data shows that 58,000 new single-family homes hit the market this week. We talked about that on Monday. That's roughly the same pace as the last few weeks and the same pace this time year ago. This inventory's build is from a dearth of buyers, not from a surge of sellers. Okay. Both home buyers and home sellers are waiting on the sidelines. This is why I keep saying, guys, go wide if you're a real estate agent. Help more people, build the database to be stronger. Don't focus on, I'm helping 4 people who are committed to buying, then 3 out of 4 drop out of the market. What are you left with? You're left with 1. 4 minus 3, it equals 1 with basic math. You've got to have more people that you're helping, educating, and thinking long term with them, building the relationships, knowing that, hey, if I'm an agent looking for low hanging fruit, somebody that's going to just buy in the next 60 days, I'm short-sighting my business in the future. Be willing to go on the 12-month journey right now, real estate agents, with some buyers, because that's how long it's going to take. Think about how many buyers you've already helped that have been on a 18-month, 24-month journey. That part of the market's not going away. Get comfortable with that. That's the reality. Just to finish up on this Housing Wire, a couple of spots in this article that I thought were interesting. There were actually more sales contracts started this week than a year ago. There were actually more sales contracts started this week than a year ago. Agents that are feeling the pain and the crunch of transactions. There's some great news for you. There's more sales contracts starting this week than a year ago, and I would argue that's with less agents. Sales have been consistently fewer all year long, but last October is when the brakes really slammed on. There are only 327,000 single-family homes under contract right now. It's obviously shockingly few, but listen, we had the brakes and the impact of the fourth quarter. We know what to expect this year for the fourth quarter. We had it happen last year. We know what to expect right now. So this begs the question, with everything being unaffordable, and Danielle Hale from Realtor.com, the chief economist there, chief economist for many years. We're hoping to talk to her over at Knowledge Brokers Podcast within the next few weeks. We're working on getting that set up. Go over to at Knowledge Brokers Pod, which I do with Tom Toole and Lisa Chinati every Friday. It's at least 2 of the 3 of us. Go subscribe over to that channel if you haven't done so already. I'm looking forward to that conversation with Danielle Hale. We've had Lance Lambert from Fortune on. We've had in the past George Ratu, the chief economist from KCM. He used to work with Danielle over at RDC for many years. We're going to have her on next couple weeks. So again, make sure you're subscribed there, and make sure you're tuned into today's business review or business planning session with myself and Tom Toole, co-host of at Knowledge Brokers Podcast. But Danielle Hale was asked the question. It's the question that everybody's wondering. This is the question that buyers need to know, according to Realtor.com. Is the housing market overvalued? And what do buyers need to know about that? Okay, so what did Danielle Hale, how did she answer the question, and how can we use this in our industry to help educate folks? If you look at how much income home buyers are putting towards their housing payment, if the number is not the highest ever, it's really darn close. That's obvious. We just went through those numbers. No one wants to buy a home at the peak of the market, then watch the home value trickle down. This is an obvious feeling. This is a feeling and a sentiment that real estate professionals need to get real comfortable with, understanding that that's the reality and understanding how to educate on that. Homes in 98 of the 100 largest housing markets are selling above their long-term prices, which indicates that they are, in fact, overvalued, according to Danielle Hale and this August analysis from Florida Atlantic University and Florida International University researchers. Only 2 markets out of 100 had homes selling at a discount. 9 of the top 10 markets were where homes were priced at the highest level above historical norms were in the South, with 7 in Florida. The Sunbelt states are the most overvalued right now, according to Florida Atlantic University, Ken H. Johnson. However, not everyone believes home prices are out of whack. Let's take a listen here. One of the things most observers agree on is the housing shortage has kept prices high. Okay, since there aren't enough properties to go around for all of those aging into prime home buying years, buyers have been trying to outdo one another with these higher offers. It happens in artwork, in commodities, in precious metals, and certainly in housing. The rarer, the more desirable something is, the more valuable it is often considered to be. So yes, we're in an affordability crisis, says the vice president and real estate consulting firm John Burns, but we have so much demand in the market. I know that you can argue housing. I don't know that you can argue that housing is overvalued because of this demand. And this is where I want to take a pause for a second. This is the question that needs to be asked. This is the educational process for home buyers and even investors in this market. If rates were to drop 4%, that's the only likely scenario we see. We don't see incomes going up 55%, and we don't see a 35% coming and crash real estate home values, not with this demand, not with this shortage of supply, basic economics, right? So if we saw a 4% over time drop in mortgage rates, is that going to open up this buyer pool, which is at the lowest level in 27, 28 years? Is this going to open it up or decrease it in your eyes, a drop in mortgage rates? Well, of course, that's going to increase it. When that increases, do you envision home prices going up or down with more competition on these homes? I envision them going up. We're potentially buying below. We're definitely not potentially. We're definitely buying today below the next peak. Okay. Could there be a valley between now and the next peak? Are we thinking about things in the next 10 years? Because if we are, then we can certainly look back on the chart that I showed previously, where in a 10-year cycle, you're going to be buying below that next peak. It's nearly impossible to perfectly time investments in the stock market. A lot of people understand stocks. They have a 401k. They understand the adage of you can't time.
Did I lose you, Ruthie?
No, I'm going to get rid of him. And
Okay.
yeah, just want your thoughts.
I think it really comes down to the buyers have to be willing to put up with the pain of the higher payment. And it depends on where they're renting and why they're moving. It comes down to the buyer pain point. Because as he said, there's people aging into the home buying market. Prices are going to go up. They're going to go up. If you don't buy one right now, you're not going to get one at these prices. 430, 440, 450 median sales price. We pulled up homes under 200,000 the other day. There was a few nice houses, nice houses.
Yeah, if you look, I don't have my chart here, but that's a good part of the market. And I see townhomes and I see condos more and more coming on the market at 20% increase in price, because the 300, 350, when you look at it, that's not such a bad payment, and people live in the payment.
Well, and a lot of buyers say, well, I don't want a condo. Well, an apartment is nothing more than a glorified condo. You're in a condo right now. You're living in an apartment.
Yeah, and the apartments aren't, they're not cheap either.
No.
Not at all. And getting into them almost is as much as a down payment. So.
Well, it really comes down to finding the people that are motivated and are willing to put up with the pain of making the move, packing their stuff, qualifying for mortgages. As he said, qualifying is not easy anymore, but we still doing, what'd we do, 2,400 sales last month, 80 a day?
Yeah.
That's the number that you had on your chart, 80 or 81 a day for the month of September.
Right.
So that's 160 closings for buyers and sellers when you add both sides of the deal. There's some people that they're pulling the trigger. They're closing their deals.
They are. I think it's going to be interesting. Like you said, 1 out of or 24% of the market is investors. And then there's so many people here that are retired and continue to move here. I think that our market is a little bit insulated from the investor standpoint and the senior standpoint. And then, like he was saying, if 83% of the people have a mortgage less than 5%, that leaves 17% of people that just might sell and buy. Mm-hmm. So there are some points in the market that I think perhaps our job as brokers and trainers that we are and educators is to get the agents to focus on the parts of the market that are seeing the action.
Yes. Yeah. We have to, if we buy into this doom and gloom, then we're one more reason for them to say, well, you know what, let me keep looking.
Yeah. So I think that, I love that you're doing the Chris Voss with the negotiating skills right now, because I think that if you're talking to especially investors, you can perhaps get some more investors if you know how to talk to them and you know how to negotiate for them.
Well, and that's what you and I are going to be looking at this next 30 days or so, finding some investors to do some projects.
Yes. Yeah.
We'll see. We'll
They're
see.
out there. They're out
Yeah.
there. Well, Jimmy, I'm going to put some videos in the group that are for them to use with some of the AI tools and put on reels and stories and shorts and so on and so forth. So the video would be in the background for them, and they would be like in a little cameo position, saying something, and short and sweet though. So I'm going to do some of that, and I wanted to have it ready for our Tech Tuesday yesterday, but I didn't, because the other things, I was away for the weekend basically. But in the weeks to come, I want to start teaching people how to get themselves out there more. And I can tell by the questions we had in the tech group that they're not doing it.
There's no question. There's a skills gap there that real estate agents are looking to find a way to fill that skills gap. And with your classes and with your videos, that might be the way to fill that skills gap. Because if you don't know how, you can't do it. You got to know how.
Exactly. Yeah. Well, Jimmy, you're off to a meeting, and I'm off to the office, and I guess I'll see you later. You're going to be at the office later, correct?
Yeah. Yeah. Once the meeting's over, I'll be at the office. Yeah.
Okay. And just one last comment.
Yeah.
I thought that was an excellent video.
A lot of information on there, and people that are smart that are making their predictions, but it comes down to you got to work really hard right now. You just have to work really hard
and target the right market.
Yeah.
Yeah. Okay, Jimmy, thank you so much for being here today, and I will see you later today.
Okay, I'll see you at the office.
All righty. Bye.